Big banks issue warnings when they notice troubling signs in the economy. These are signals that something might be changing beneath the surface. Think of these warnings as a weather forecast, but instead of predicting rain or sunshine, they're forecasting the financial climate. When a major bank like Bank of America raises a red flag, it's not just for their own benefit. They want everyone, from investors to everyday people, to be cautious and aware. This means that experts at the bank believe there's a real possibility that something negative could happen soon, such as an economic slowdown or even a recession. But what exactly is a bank warning, and why should we care? It's important to understand that a warning is not a guarantee that things will get worse. It's more like a caution sign on the road ahead. Instead of predicting doom, it's a strong suggestion to pay closer attention to your finances and the broader economy. Banks have teams of experts who study numbers, trends, and global events very carefully, looking for patterns that might signal trouble. If they spot potential problems, they share their concerns with the public so that people and businesses can take steps to prepare and protect themselves. For most of us, hearing about a bank warning can be unsettling or even frightening. News headlines might make it seem like disaster is right around the corner, amplifying our worries. But it's crucial to remember that these warnings are meant to help us prepare, not just to scare us. They serve as a heads up, a reminder to stay alert and informed, not a prophecy of doom. In the end, a bank warning is a valuable tool, like a flashlight in a dark tunnel, helping us see what might be coming. It helps everyone, workers, families, and companies, get ready and make smart decisions if the economic road gets bumpy. And that's exactly what's happening now with Bank of America's latest statement, a timely alert so we can all be better prepared for whatever comes next. Recently, Bank of America sent out a new warning about the United States economy. This alert has caught the attention of investors, business owners, and everyday Americans alike, as it comes from one of the country's largest and most influential banks. They said there are growing signs that trouble could be ahead. The bank's analysts are noticing patterns that suggest the economy may be heading for a rough patch, and they want people to be prepared. The bank's experts use phrases like slowdown, risk, and even recession. These are strong words that signal serious concerns about the future of the economy. These words got a lot of attention in the news. Financial networks and newspapers quickly picked up the story, spreading Bank of America's warning across the country. Bank of America's main concern is that the economy is losing steam. Growth is not as strong as it was in previous months, and some key indicators are starting to look weaker. They pointed to data showing that businesses are not growing as fast as before. Sales numbers, profits, and investments are all showing signs of slowing down. Some companies are cutting back on new projects. This means fewer new buildings, less expansion, and a more cautious approach to spending. Others are hiring fewer workers or even letting people go. Layoffs and hiring freezes are becoming more common as businesses try to save money and weather the uncertainty. The bank's statement was clear, but not panicked. They wanted to inform the public without causing unnecessary fear or alarm. They said, "We see reasons to be cautious." It's a message meant to encourage careful planning and smart financial decisions. This means they are not sure a recession will happen, but they think it is possible. The future is uncertain, and they want everyone to be aware of the risks. They want people to understand the risks so no one is caught off guard. Being prepared can help families and businesses make better choices if the economy does slow down. When a big bank like this speaks up, it is wise to listen. Their warnings are based on careful research and experience. Many other banks and experts are watching the same warning signs. The financial world is paying close attention to these developments. If several banks agree, it is even more important to pay attention. When multiple experts raise the same concerns, it's a signal that everyone should take seriously and consider how it might affect their own finances. So, What is causing all this concern? One big reason is inflation. Prices for things like food, gas, and housing have gone up a lot in the past year. When prices rise too fast, it squeezes everyone's budget, people buy less, and businesses make less money. Another issue is interest rates. The Federal Reserve, America's central bank, has raised rates to fight inflation. Higher interest rates make it more expensive to borrow money. That means higher payments for things like homes, cars, and credit cards. When borrowing slows down, the whole economy can slow down too. There are also problems around the world. Wars, trade disputes, and supply chain issues make things even harder. When countries argue or when shipping slows down, products take longer to arrive and often cost more. Put all these issues together and you get a lot of uncertainty. That is why Bank of America and other experts are raising their voices. They want people to see the risks and make smart choices. This is not the first time banks have warned about trouble. Throughout history, financial institutions and experts have often tried to alert the public before major economic downturns. Back in 2008, banks and experts warned about problems in the housing market. There were signs everywhere: rising home prices, risky loans, and mounting debt. Most people did not listen, and the Great Recession followed. The warnings were there, but many ignored them, thinking the boom would continue. Millions lost their jobs and businesses closed. Families struggled and entire communities felt the impact for years. If we look even further back, in 2001, after the dot-com bubble burst, banks warned about a slowdown. Technology stocks crashed and the economy faltered. The stock market fell and many people lost savings. Retirement accounts shrank and investors faced tough choices. Even before that, in the early 1990s and the 1980s, there were recessions that started with warnings from banks and experts. Each decade brought its own challenges, but the pattern was similar. Each time, the warnings were not always clear or loud enough. Sometimes they were buried in technical reports or overshadowed by optimistic news. Sometimes people ignored them because the good times felt like they would last forever. When the economy is booming, it's easy to believe nothing will go wrong. But looking back, those warnings were important signals. They were early signs that could have helped people prepare if only they had paid attention. History teaches us that it is better to listen and prepare even if the worst does not happen. Taking precautions can make a big difference when times get tough. No one likes bad news, but forewarned is forearmed. Being aware of risks helps us make smarter decisions for ourselves and our families. That is why Bank of America's new warning matters today. It's a reminder to pay attention, learn from the past, and be ready for whatever comes next. A slowdown or recession affects everyone, not just banks or big companies. The first place people often feel it is at work. Companies may freeze hiring or cut jobs, hours can be reduced, and raises may disappear. Prices for everyday things, groceries, gas, rent, can keep rising even when paychecks do not. That makes it harder to make ends meet. People may have to cut back on things they enjoy or need, from eating out to family vacations. Savings and loans are also hit. Savings accounts may grow slower as interest rates change. Loans like mortgages or car payments can get more expensive. Some people find it harder to borrow money at all. All these changes can feel stressful, but understanding why they happen can help people make better plans. The warning is not just for Wall Street, it is for everyone on Main Street too. So what can you do if you hear a warning like this? First, take a close look at your budget. Try to cut out extras and save a little more each month if you can. Every bit helps in a pinch. Second, try to pay down high-interest debt. If you have credit card balances, work on paying them off. This will make your monthly bills smaller if times get tough. Third, build up emergency savings. Even a small cushion can make a big difference if you lose a job or face an unexpected expense. Many experts say aim for 3 to 6 months of basic expenses. Finally, keep your skills sharp. If you have a job, look for ways to learn more or get new training. This can help you stay valuable at work or find a new job if you need to. It is normal to feel worried when banks warn about the economy, but it is also important to remember that tough times do not last forever. People and economies bounce back, even after deep recessions. Communities pull together, new jobs are created, families find ways to make things work. History shows that while recessions are hard, they always end and often bring new opportunities. If you prepare, stay informed, and support each other, you can get through. The warning from Bank of America is a sign to be careful, not to panic. In the end, people have faced hard times before and come out stronger. With a little planning and a lot of hope, we can do it again.